Welcome to our CFP exam prep discussion, focusing on health savings accounts, specifically HSA eligibility requirements and their connection to high deductible health plans. This topic frequently appears on the CFP exam, and understanding its nuances is crucial for success. Let's break down the fundamental concept of HSA eligibility. To qualify for an HSA, an individual must be enrolled in a high deductible health plan. Many candidates miss that this is an absolute requirement. You cannot contribute to an HSA if you have any other health coverage, including Medicare or being claimed as a dependent on someone else's tax return. The IRS defines specific criteria for what constitutes a high deductible health plan. For 2023, the minimum deductible must be at least $1,500 for individual coverage or $3,000 for family coverage. The maximum out-of-pocket expenses cannot exceed $7,500 for individual coverage or $15,000 for family coverage. These numbers are adjusted annually for inflation, so avoid memorizing specific figures for the exam. A common mistake test takers make is confusing HSAs with flexible spending accounts or FSAs. While both offer tax advantages for medical expenses, they operate very differently. HSAs have no use it or lose it provision, and the funds roll over indefinitely. The money in an HSA belongs to the account holder, even if they change employers or health insurance plans. The tax treatment of HSAs is particularly important to understand. Contributions are tax deductible, even if you don't itemize deductions. The earnings grow tax-free, and distributions for qualified medical expenses are tax-free. However, be careful with non-qualified distributions. They are subject to both income tax and a 20% penalty if taken before age 65. Another tricky area on the exam involves contribution limits. For 2023, the maximum contribution is $3,850 for individual coverage and $7,750 for family coverage. Test questions often include catch-up contributions. If you're 55 or older, you can contribute an additional $1,000 annually. Remember that these limits apply regardless of when during the year you become HSA eligible. The exam frequently tests scenarios about partial year eligibility. If someone becomes HSA eligible mid-year, they can still contribute the full annual amount if they remain eligible through the following year's testing period. This is called the last month rule or the full contribution rule. However, if they fail to maintain eligibility during the testing period, they must include the excess contributions in their income and pay a 10% penalty. Students often struggle with questions about qualified medical expenses. These include most medical, dental, and vision care expenses not covered by insurance. However, insurance premiums generally don't qualify, with few exceptions like COBRA premiums or long-term care insurance. Over-the-counter medications now qualify without requiring a prescription, a change made permanent by recent legislation. One final point that often appears on the exam concerns spouse coverage. If either spouse has family HDHP coverage, the HSA contribution limit is split between them unless one spouse has other disqualifying coverage. This becomes particularly relevant in coordination with Medicare, as Medicare enrollment disqualifies an individual from making HSA contributions. Understanding these HSA concepts thoroughly will help you navigate related questions on the CFP exam. Focus on eligibility requirements, contribution limits, and the tax implications of various distributions. Remember that the exam writers often create questions that test these concepts in combination, so practice applying multiple rules to complex scenarios.